and that we've done for the past 5 decades. We're celebrating the 50th anniversary edition of the Stock Traders Almanac. And it's available everywhere books are sold. And for me, if you're looking for a special offer for my stuff, you can reach out to me on the website or however. I don't want to sell hard here at all. But, without Yale and the Almanac um, putting market cycles and seasonality on the Wall Street map, none of us would really know about it. A few people were dabbling in it years ago, but Yale really put it on the map. And with this iconic work in the Stock Traders Almanac that I'm humbled by Danny commenting on so much and how he uses it, and as well as the Pitbull and a host of other people. So we continue to do analysis with all sorts of cycles and seasonalities, down to some currencies and commodities. So some interesting trades we've come up with recently, which I'm not going to really get into here, including the British pound long that we got into, and some copper stuff, even that ran ahead of us a little bit. But the stock picking right just before the election, we had a basket that we put out in September around the end of the worst 6 months, beginning of the best 6 months. Some real screamers there. So any of you guys trade stocks, might want to take a look at that. But let's look at what the Almanac and our extensive 5 decades of research is showing us about next year and the Trump vibe and the Trump rally and so forth. Um, and just a little history of what we've done. Here's a couple of the books, a little backdrop, the 68 Almanac with a little inscription from Yale, this 2017 Almanac. I love this title from the 86 book that Yale put out, Don't Sell Stocks on Monday. My super boom forecast, which is now much more credulous than it appeared to many people back in 2010, for the Dow to get to 38,820 by the year 2025, and all the wonderful places we get to spew our thoughts out there in the television and internet. A little cute picture of me and Pop from '03. For those of you that see me recently, there's a lot more hair here. You can see him gravitating toward Yale's bald spot. Yale on over here with Lou Rukeyser in Wall Street Week back in the late 70s, early 80s, sporting that bushy 70s mustache when he made the Dow 3420 forecast back in '76. And just a little rundown of what we're looking at. Our philosophy is a flip side of the sort of based upon the Santayana quote that those who fail to remember the past are condemned to repeat it. But we always keep our friend Sam Stovall's words in our head that we use history as a guide, not as gospel. I've been pestered, or at least asked recently about, where was the big sell-off in the summer? Well, no one ever guaranteed or said there was always a big sell-off in the summer, but it's definitely a flat out a week period. So as a guide, not a gospel. 4-year cycle at a glance, going back to 1941, the first full 4 years since the last time that the Dow was down in the pre-election year, the third year of the 4-year cycle, in 1939 when the Germans invaded Poland. We had the first loss since that time in 2015. Looks like 2016 is compensating for that. We do have a tendency for some weakness or at least softness in the first 2 years of the term, where we see most bear markets, wars, and recessions occur. Election year, as you can see in the last 65 or so some odd years, been taken on the chin a little bit. We had '08 and 2000, some pretty nasty bears, and some flat years in '04, '94. So something to look at there. Keep your eye on. And this election year sort of back in the mode of being a little bit more bullish in the midterm and and post-election year. A little look at some of the concerning points in the first year, the post-election year. All these big bear markets have occurred in the post-election year. Something that we have been concerned about, more so prior to the election, and I'll get into a little bit about what I think the handicapping is on Trump. All of our major wars have begun in this post-election year. There are times when the post-election year has not been so horrible, namely after the '29 crash and the 4 straight down years. We had a big up year in '33 when FDR came in during the big secular bull and boom of the '80s and '90s. But there, the 21st century, we had a couple of down post-election years, '01 and '05, and even though '09 was up, 19% for the Dow, was up 59% off that generational bear market low that we had. Performance by party, just a sort of philosophical or ideological look. Democrats and Republicans have a different mindset. Republicans a little more conservative, or a little more set in their ways, ready to hit the ground running and take names and kick butt and push through as many of the difficult or perhaps unsavory policy initiatives. You see weakness more prevalent in the post-election year under Republican administrations. And whereas the midterm year, Democrats hemming and hawing for a little longer, waiting to figure out what they want to do, tend to push things through more so in the midterm year, and you see a little bit more weakness in the midterm year for Democrats. So again, sort of a negative for next year if you were to look at it historically that way. But things are quite different. Just a quick shot of a page out of the new 2017 Almanac, of course, well before we knew who had won or was even the final candidates for the different parties. You can see the one succeeding Democrat doing quite well. New Republicans, of which Mr. Trump is or will be. Everything goes as planned. Some trouble in those first years of Republican administrations as they come in and sort of mix things up out of the blocks. And now, one of the charts, the style of charts we look at for seasonal analysis is this sort of 1 year consolidated or combined seasonal pattern or 1 year pattern. So in the blue line, we've got all election years since 1953, all post-election years, excuse me. All first elected, that means first term presidents in the red line, and the green line is first elected Democrats, and the black line is first elected Republicans, which would be Mr. Trump. And I think the real takeaway here is they all sort of track closely together the first half of the year, at least through the first 4, 5, 6 months, bouncing around a little bit as the first 100 days and the first 2 quarters, as we see what these new administrations bring to the fray and what they can execute and how well they perform. And then you see sort of in July, towards the summer, you see sort of a divergence, a separation where these new Republican administrations, the thinking is that they've put a lot more initiatives through, sort of changing things up. You see that sort of separation into that, typical September, late August, September decline, October turnaround. So one of the things we're looking at seasonally throughout the year lines up very well with the worst 6 months, the Sell in May vibe. But just to look at the difference between the parties and all post-election years versus new presidents. So what does the election outcome mean for stocks? Looking at the political alignments, thank your lucky stars that the Republicans held on to control of Congress, because that's the real clincher from our research. And this is all years under these different political alignments. Not presenting here the Democratic president side because it's not necessarily relevant at this point in time, but a Democratic president and a Republican Congress is the best combination with an average return over all those years, not just the first years, not just post-election years, but all years where this political alignment was present, of about 16.4%. So you can see having Paul Ryan and Donald Trump working together is probably a positive for the stock market. And then looking at some more, drilling down a little bit, one of the main concerns we have here with this volatile, unorthodox candidate or president-elect that we have is any sort of stumbles that he has in the first 100 days or 2 quarters. And they've been trying to really highlight anything in the media that he's done wrong or that is potentially unsavory in this cabinet position filling thing. So if he stumbles, we think the market could fall. Our initial outlook for this year was a little bit more negative, but now that we're seeing all this change coming, all this positive change, less regulations across the board, being a plus across the board. We've seen some sensitivity some weakness in some of the rate sensitive stocks and sectors. The military looked like it was going to be pretty good, but he seems to be playing some hard role with them, so maybe not as much as we thought, but probably a good place. Healthcare and biotech and pharmaceuticals, likely to face regulations, but if they're going to scrap or really do something to Obamacare, which has been a silver platter for that industry, it might be a little bit of a drag there. We had rotated out of tech. It looks like we're trying to start to rotate back in. Financials have been on a tear. I just took some profits on my XLF trade. Of course, it popped today the day after, but we took about 20% on that in a few months. I think we got some strength from infrastructure spending in industrials and cyclicals, and energy is looking like it'll do well. The war on energy likely over. So that is, I think, the last slide that you guys have. Oh no, there's one more thing here. This is an interesting thing that came from a tech chartist, a guy over in England, Alex Sparaglu. I can never pronounce his name. It's of Greek descent, and he's an MTA guy, Market Technicians Association, and he saw that created this comparison. I added on a little bit more here on the right side of the sort of shock phase after Brexit, which was over a couple of days, compared to the shock phase with the Trump election. I know some of you guys hopefully bought that in the middle. I'm not a future trader. I was telling my colleague that we should have gone long at midnight there, where the Dow was limit, or the S&P was limit down, and Dow was down what about 5, 6, 7, 800 points at any given time. And then you had this recovery phase, a little bit of a sideways phase, very similar to the Brexit sell-off. And here we are, popping up a little bit higher than this now. We're looking if we can, if we repeat this, is this sort of a similar false breakout and we roll over in the first quarter at the end of the best 6 months, or if this rally's really got major legs right now at this point. And just a little technical thing we're looking at there. And that's all I have for you. Trying to keep it short and sweet. Reach out to us on the internet and Twitter, anywhere else, across email as well. So thanks, everyone. I'll hand it back over to you. Can I answer that question? Good question, George. Still looking for the big major sell-off before the super boom run. It's sort of a little less so, because I think we may have, if as I was saying, if Trump can really perform and not screw it up, we may have seen that sell-off in January, February, that sort of August 1982 moment. But if he screws the proverbial pooch, then we may get that major sell-off. So I'm hedging on that, depending upon the performance of this new unknown. And I thank you all. And from your mouth, London C, that Trump will perform. I don't underestimate him, but you got to hedge a little bit. You got to have a little downside protection. So we're going to stick to our methods and our systems, which the only times that we really mess up is when we don't follow our methodology and our trading strategies, like Danny said at the beginning. So I wish him well. I wish us all well, and perhaps we are at the beginning of that big super boom. The only missing factor yet, or the one that looks like it's coming into place, is this functional government. Inflation's starting to pick up. Looks like we're winding down some things over in the Middle East, and then we'll be looking for that what I call a culturally enabling paradigm shifting technology. Maybe it comes out of robotics, maybe biotech, maybe energy tech. I'm not smart enough to know what it will be, but something will change the world, touch all of us in a quintessential way, and change the world. So I will relinquish my time to the gentleman from Chicago. Thanks again, Danny, and thank you, George. Thanks, everyone. Ciao.
Okay. Well, thank you very, very much, Jeff, for coming in. I think who's up right now? I got all this stuff. It's it's WB, right? Oh, Jeff is the best, and I'm not kidding you guys. If you ever are in a city where Jeff is appearing, I would suggest that you go see him. He really knows his stuff. Okay. So next up, and anyways, listen, and hey, Jeff, do me a favor. Please tell your dad and your mom I said the best of holidays to them and to you and your family. Whatever I can do. I know you're going to be down here in Orlando. Give me a call when you get down here. But next up, we've got William Blount. And like I said, got a lot of respect for William. He didn't just wake up one morning and find out these formulas for Elliott Wave and all the stuff that he does. He's been doing this for a long, long time. And I guess if there was anything that I would say is that it also takes a long time to kind of learn the trading ebonics that he uses, but he's been doing a lot less of that lately, and I'm hoping that today he's going to really put on a great show. So anyways, what I'm going to do now, my friends, I'm going to turn it over to William, and we will see you. I'll come back, and then I'll introduce Shy Stock, and then I'm coming back. And like I said, my view is going to be a lot different than everybody else's. We'll talk to you in a minute.
Y'all hear me? Somebody hear me? Can anybody hear me? Hello? 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 All right, let's rock. Okay, my name's Bill Blount. That's B-L-U-H-N-T. And that's the proper English pronunciation. And the language I use is strange to most traders, but it's not Ebonics. Far from Ebonics. Most of it is very literal and very visual. And it was developed because I was co-managing a piece of a trust down in Gibraltar with a guy from Wakefield. And back then we didn't have Skype. All we had was a Microsoft Room. We could type back and forth to each other real quick. And a lot of it was based on, let's say, technical analysis concepts that I'd put together since 1984, watching intraday charts, as well as top-down quarterly charts down to 5 minutes originally. I don't use 5-minute charts right in. Then 3-minute trades. And I don't know what they're advertising there. I came into selling my crap by being by the short hair. He wanted me to sell it. And I have, and I figure the price of admission is about right. $29 a month. But for me, it's just hitting the send button. Anyway, what I really want to start off with before I get going anywhere is I want to tell the Mississippi Queen I love you. Glad to see you signed in today. And you know you're in my prayers every night. It's real good to see Chris from Texas to wherever you moved to. And then a real treat for me today is two people who've actually been looking at my work since 2004 here. That's Bob S. and Sarah. And I don't know, I count myself real lucky to know both of them, but JC is the queen of the ocean. Helped me immensely through the years. But anyway, let's talk about this Trump thing. And I had been following, in other words, I've been very aware of Jeffrey Hirsch's dad, Yale, since, I don't know, 79 or 80, 79 or 80. And also aware of his work and have had a few email exchanges and sidebars with him in Danny's room over the last, I think I left the Abbott in 2010. And it's not real, what it is my work is kind of real visual, but it's real literal. And I want to talk about this Trump thing today too. And I hope that what you're looking at is a weekly full alternate count that dates back to, I don't know, beginning of the February rally. And these charts don't get changed. I've been working with this same basic chart, and the people have been receiving it just about every Monday since we went through 1434.44. on the back through of that price following Obama's election in 2012. I don't know how to post anything in here, so I'll just read it to you. There's an elderly gentleman in New Jersey who has saved every commentary that I've written since 2007, early 2008. And he was an old Avid player that went by the name Plato. Before that, I could access everything I wrote at Avid, and I posted at Avid from 2001, late 2000 through 2010. And I think the first post I wrote when I got there was two posts. It was teach your children Mandarin. That was about 15 years ago. And a generalized comment on technical analysis. It all works and none of it works. You can't take money management out of the equation. And when you're trading leverage products, I'm a firm believer that it's better to know when you're wrong than when you're right. But I'm sitting here looking at an email from Monroe where he basically said, even found the chart for 3/6/2009 all marked up with your lines. The lowest one at 663.03, a perfect hit on that afternoon low. Well, that's where the origin of this chart is, but you can't see the left-hand adjustment on it. I think you're cut off on the major one high, major two low of the movement for the primary wave one off 666. That primary wave one is a truncated high where the first Roman numeral red one is. And then if you kind of look to the right, you can see the 1434.44 back through. And the reason why that is so important following an Obama election is because that's the last place the bears had a chance to view this market as a bull market rally within an existing bear market that started at 1579 or 1576.09 on October the 11th, 7, which was the 5-year anniversary of the 2002 low. And then we made all that big drop. Now, and I'm going to bring this in real quickly. The 2000 to 2002 drop was actually a far scarier ride because the market had no prior information of what would happen in an economy where you turned your whole economy over to a bunch of 26-year-olds, also known as the dot bomb or dot-com bust. And it was a heck of a lot harder on Abby Joseph Cohen and the NASDAQ players than it was the 50% haircut the S&P players took. And there were far, far more limit down moves during that drop. And there were really very few during the 2007 to 2009 drop. It was pretty. If you follow this chart on up, it says read commentary 2.8. That pretty much shows you the last time I had to add anything to this chart, which was February this year. And the actual high or 5 equals 3 is a date that long-term readers know I look at every year, and that's May the 22nd. And the actual close high was on May 21st, and the extreme high was on May the 20th. And those highs were at 2134.72. The bottom line is when we get down to 1810.1, which is where C equals 4, that same day when we went back through 1827, I posted in real time that we were due for 110 to 100, 115 to 160 handle bounce, and it was in the commentaries the next day. And that would take us back up to at maximum an area between 1961, 65, and 71, which later became known as the perestroika, and it would fail there, or it would eventually go to 2077, which is where the lean would flip to where the only chart that would be shown was this bull chart. And that was duly noted in April of this year. Now, the bottom line on this is if you look at those numbers in that box, you're going to see 2138. And the reason that number is there at the bottom of the box is because when I was trying to nail down that Roman numeral 3, I had a target range of 2124 cash to 2150 cash centered on 2132.5 and 2132.5 and 2138. So because the first one, that red one, was truncated, which means you actually put an Elliott high there that's a lower high than the absolute high, and I'm not going to get into all the esoterics of Elliott wave. And it's one of only, the truth is I know an awful lot about Elliott, but I also chased Gann for 5 years, very, very hard, and have read everything I can read about cycles, and talked about those as much as I know how to talk about them. But there are other people that I get correspondence from that are better than me at cycle work, and I want to mention Ian right now as far as that goes. He's pretty good at them, and anyway, and so is a guy by the name of Jim Curry, and uh, and then I rely on a guy by the name of Dr. Jeff Tennant, or Eyeballs, to take care of DeMark for me. Now, in a lot of cases, I know how to do all these things, but I'm a one-man show, and it has been real nice to have people that I've been able to trust. For all these people date back more than a decade of nightly correspondence to use their work to see if it fits mine. And you have to be comfortable enough with your own work. The way I always write it up is to be able to fade your mother, especially if you're day trading. And I would do it in a heartbeat if my stuff told me to do so. So let's get back to that box. You got the 2138 there, and as we know, that was eclipsed. And then the 2165 was another big number. And then above that, you got 2214. Well, that 2214 was a known quantity from the moment that the little red 1 and little red 2 above the large Roman numeral 2 was in place. That Roman numeral 2 is at 1,074.77. And 2214 was one thing I don't like, and I know I'm kind of bouncing around here. I disdain people who sell stuff and then always give you an end of the world call, or we're going to the moon tomorrow call, and then they put the moon so far away that it really doesn't fit your time frame unless maybe you're doing position trades. You know, they'll say, oh, you know, and then they get married to their projections. And I've had enough experience with wives and divorce attorneys to have learned a long time ago that if you use a crystal ball, you're going to eat a lot of glass, and that you don't marry your projections, but you do have to have a good way of tracking them. And I think that's what I do pretty well, is track a movement and say, well, this is what has to happen next. It's like monkey bars on a playground. You have to go here first and see if that's going to work, and then you can move to the next monkey bar. And the key to me was touching that 2077. Once we touched 2077, although I warned everybody not to put go all in at that point because I thought we weren't done with batting the ball around, and that batting of the ball around ended up being the Brexit dump, and the inability to convert 2103.5 S&P, which was the price of the year thus far this year, in my opinion. Those are S&P futures. Convert that to hard support. There wasn't any, cause to get in a big hurry. So I would say the best from this year, I've been real happy about the year. I warned everybody about an analog trade, which is these, where you compare to a prior time in history. It would kick off at the beginning of the year. It would behave similar to the analog from 2007 going into 2008. And it was predicated upon breaking a very specific price, 2,044 cash. And we closed that that particular day, the last day of this year, at 2,043.97. And we didn't really look back till we got down to 1810.12, which is the left-hand side of that double bottom at C equal 4. Then the actual low followed the bounce back to the 1919 to 1940 area, which were spots on the charts that were given in advance. Then we reversed down and made the double bottom. And at that point in time, I thought we were good for 115 to 160 handle. But when we got to 2077, I started talking a lot more about the 2214, which I gave. There's a lady that does a lot of work named Kathy Gerber or Garvin. Kathy G at Structural Trading. That she's kind of like, for old timers that know Madrone, Steve P. She's pretty good with Gartley's stuff. And I told her to write it down, and I've got that email too. Mark this price down. We're going there, and that's 2214. And we recently spent 9 days trying to get on that 2214 and get it done. And that's what gave us the Renza drop. Now the Trump drop, and I'm gonna move charts so that you can see where we are now. And you can see how everything's all crammed in. That Trump drop has been one of the biggest disappointments of the year for me, because it lasted 5 hours and it was strictly in the futures market. And in July, I began warning people about an 8 to 10% drop, and we ended up having 2 extended sideways trades in July and in August, trying to get that top fixed. And a lot of that was just reactions to holes and whatnot. And I also began discussing in June of that year that when this bull market did resolve, it would resolve as an ascending triangle or a blow off. And Mark W., who is a member at MTS, we were brokers together back in 1978 to about 81, 82 at Merrill Lynch when he left. He showed up at MTS unbeknownst to me, and after he posted a few times, I said, "Have you been to Lakeland, Florida?" And my gosh, it was somebody I hadn't seen in 30 years, and we've been talking about this blow off for well over a year now. And I hung it on the idea that the blow off would be Donald Trump winning, and that the minimum price would be $23.64, and it was given this summer, June 27th to be exact. Thank God for Google Drive now. All my stuff is easier to ascertain, easier to access. Danny says I do the work. I've got about 35 or 40 spiral leaf notebooks filled front and back with each day that we do. And it's all it is all the numbers. And then I might jot some things down on that sheet. And that's all longhand. And I do that so that prices will stick in my head. And then I've been cursed or blessed. If I have any, I guess it's kind of lucky gift. I can memorize. I can remember almost every turn of any significance in the market, dating back to August of 1982. And I looked at this rally and saw there was a lot of similarities to 1984, the rally that started on July 27th. And anyway, right now we've done everything but declare the blow off. And in order to do that, there's a rule, and there are very few rules in Elliott. They're mainly statistical observations, but one rule is on an impulsive move of 5 waves, the third wave, which is the move from the Brexit low to the 2193 high before the Trump drop, that Brexit move there is 202.13, I believe, handles long. All you do is add that to the Renza low, and that tells you if we got to get out over 2285.93, and if we do, all the pencil and eraser crowd, the Elliott Wave people, and I'm a member of that society. I mean, I'm a member. I don't subscribe to any of them. Don't get me wrong. I haven't. I have the immense respect for both Glenn Neely and Robert Prechter for bringing this junk to the public. And it was I only got interested in it because an uncle of Robert Prechter's was a customer of mine at Merrill, and so I decided to learn it, and I think I know it. So anyway, we got to the 2214 and we fiddle-faddled for 9 sessions. And then if you'll notice the day that we took it out, and all my work has a margin of error of plus or minus 2 handles cash. I know a lot of Elliotticians think that's too tight, but I figure if it's what they claim it to be, God's order of nature in a mathematical form, that, you know, it ought to be tighter than 10 or 12 points. It ought to be more like 2. That's a joke, folks. So anyway, got through the 2214, and here's the deal. You can see that 2364, and that's been on there for a long time. That 2525 is misleading by 10 handles, and I'm gonna fix it soon enough. I'm pretty lazy. That 2525 is now really 2515, and the reason why is it's the differential between 1820.66, which is where the red 4 in 2014, the blood red 4, like a dart red. That's 1820.66, and a lot of people were saying the bull market's over, and I didn't think it was at all. The reason why I didn't think it was the bottom was because it didn't move far enough by 1.3 handles to qualify as a Roman numeral 4. And so anyway, that's that. And so if you take 1820.66 and subtract 1810.1, you'll come up with about 10.5 handles. Then you subtract that from 2525, and that's the new 2525. Now I'm going to tell you where we're going to go if Trump threads the needle. Then I'm going to tell you why we may not get there if he doesn't thread the needle. And some of that has to do with what Jeff Hirsch was talking about. If he threads the needle, we're going to go to 2717 to 2870, which is not on that chart. And I promised everybody at MTS I'd provide some new information today. And all of that's going to be part of a 4-part series that I started, and it's a little more political and bent, and it's called the Coliseum. And part 1 was delivered to everybody on September 27th, and then part 2 shortly thereafter, and part 3 is going to really put a lot of flesh on everything that's going on in the world. But you're hearing a real skinned down, not much to it version of this right now, and you can write those numbers down. I don't care. And it's 2717 to 2870. The only person that I've seen that's called for a true blow off was a long time ago, and that goes back probably while we were headed towards. You see it's really a third wave grind move. Once you go through 1434 and you don't see any assignments all the way to 3, that's a grinding third. And this whole market has been characterized by grinding thirds and by little or no blow-offs. There was one blow-off, if you look at that chart from 1434.44 straight up to the May 22nd high of 2013. That's a blow-off move. And that one came in at 1687. And long-term readers know that's where Billy pulled the rabbit from the hat, which was written in the commentary. But I said in no ways will we take out 1471. And when we got down to 1560, it was a number that there were too many eyes on. And so I got lucky and nailed that low. That was just, you know, one of those things. And anyway, the next move here takes that diagonal triangle off the table at 22.8593 plus 1 penny, and then you get the market can open up to higher prices to come. Now, also, when you hit these things on a first pass, there's usually a good fade trade for swing traders that are in the market for 2 to 3 days. And all my writing is done on a day trader's basis, and then followed by swing traders basis, and then position traders basis. Most of the bigger picture stuff is reserved for Mondays because I have all weekend to do the work. And I was kidding around with I think some guy named Don in here, or Dan, and he said, "Oh, we're headed down." And I said, "You want me to show you why?" And I said, "Well, the real deal is when I came in first thing this morning, identified that we would, that we were in a specific type of day, and I was a little late getting here, but basically I had a resistance area at 264.5 to 2267.50, which was developed yesterday, and it was the no man's land. And that 2267.50 is the first print of a price after Janet Yellen's interest rate announcement is made at 2 o'clock, and that's a real important price because everybody above there that's short, that's long, gets trapped if we go down, and everybody below that, I'm sorry, everybody that's, in other words, everybody that's long from above that price is trapped once we go back down. And then the 2264.50, which was yesterday's opening, and the first push up high of the day was 2264.75. That becomes a target that has to be taken out on the downside. And everybody knew on Monday that the biggest price was 2242.50. I'm giving you ES prices. But then once we had the big day up on Monday or Tuesday, the 2257 price had to be taken out. And I think if you were to construct a chart, you'd see that those prices worked real well. Yesterday we got down to 2243. The high of the day was 2272, which was also a spot. And that's how that goes. So that's where we're going. And I'll talk about timing a little bit in just a second. And that's why we're going to go there. If we get the blow off, which I wrote, represent a blow off, and Hillary would represent the triangle, and then we would get our ears pinned as soon as that finished. I only need a little bit more to start looking for this thing to be in blow off stage. Most important price on your chart right now is 2083 cash, and a little bit lesser extent 2187.44. you really don't want to see that 2083.79 taken out, because that's where the actual cash in the real trading hours of an American index took place. That's your cash low for Trump. Now, what you do want to do, and I'm going to give you, you can go ahead and take a pencil and paper and write this one down. Limit down move that night was to 2029.50, right by the 2031 Debbie the Mississippi Queen spot. And it also has to do with the 2034 area, which was tied into that old 2044 that produced the dump this year. It's an old saw in the market. Support becomes resistance, resistance becomes support, and you got to know if you have other types of numbers that fit into those realms, and you keep an eye on them. So the limit down move is, I don't want anybody to end up going in bankruptcy court because I say this, but I'm going to tell you the truth. Anybody who bought a limit down move between 2002 and 2008 on the long side made a buttload of money because it was oversold. You might open that limit down move and move a little bit lower, but then you skyrocket. You get these, when you're in a down market, volatility expansion, your rallies are like nosebleeds. There's like boom, straight up, and then all of a sudden you'll get a shelf where they just can't go any further, and that's everybody loading the boat up, getting short, and then you keep going until you finally hit your destination on the downside. And that's another reason that you can also look at this chart, and what I'm going to say will make perfect sense to you. Tops form bottoms happen. I mean, bam, they happen. And I have a few tricks for identifying them like everybody else. And they're located, they're tied into volume and they're tied into technical analysis. But you know, it's not as hard to call a bottom as it is a top, and you have to have a little bit more patience. So that's that. I don't know if I can't read anything and see if I can see any of these. I don't know if anybody's asking me anything or anyway. That's it. We're in a bull market. We have been since 666.79. Donald Trump was elected. We're in the blow-off move. We got to clear out one more hurdle to make sure it's not a triangle of any sort. And there's a really super bullish count that allows us to go to 27.17 to 28.70. The one guy I saw back early on was a friend of E&T's named Mahindra, who said this thing wasn't going until we got to 3,200. He hadn't been wrong yet, but that's been, you know, that's yet to be seen, and that falls in the category as I'm not going out there and tell everybody, you know, we're going to 3,200 because you know, you have to open those doors that allow you to get there, and these are the doors that I keep on my chart. And it's not that. Well, I can tell you another one, and Debbie W will verify this. The A and the B that go the dark red A up to the dark red B, then down to the C. Same day, within 30 minutes, when we hit 2104.27, I said this is the first time since 666 that you could possibly have a truncated fifth primary wave and for the bull market to be over. And it was within an hour of the occurrence, and it was done live and in the room. But the caveats with that would be that you would have to have back-to-back, very large, the Roman numeral red Roman numeral variety back-to-back. Two of the impulse waves, 1, 3, and 5. 1 and 5 both would have had to be truncated, and that just didn't seem right. I mean, it still doesn't. It just didn't sit right with me that things would be that weak. So I wasn't that surprised that we came off of the 1810 and took off, and then once we took out the troika, that we would get to 2077 if we got through the 2031 futures price and the 2000 cash. And all these things are given in advance. It's not like I'm saying, you got to do this next. You got to do this next. And it's sent out every morning and all that good stuff. So anyway, the next deal is Trump's going to come in office, and let's go over, let's talk about the troubles he's going to face. All right. I guess there's an election map there. That pretty much, I've been using this same map. I got paid a couple times to run political campaigns back in the 90s and had my stomach full. I tell you what, running a political campaign is a lot like putting together a short-term trading algorithm. It's really micro-targeting your voters and then how to get them to where you want them to go, and then the message you hit them with. And it's not that hard to do. You just got to be more clever than the next guy. And the whole United States, and I've been saying this for really all the way back to 1992, but since I've only been public for 16 years, the United States is nothing more than India in 1947. If you look at all that blue on the upper East Coast, that's Bangladesh. And if you look at 12, 7, and 55 out to Honolulu, that's Pakistan. And the rest of us live in India, but the only real contestable states are those states which border a big lake other than New York, which is firmly in Bangladesh. So the whole battle for the American presidency it really only boils down to about 60 counties in the whole country. The rest of it, your vote is pretty much taken for granted. And if you know what mean and median and mode are, all this hullabaloo about popular vote and everything, basically you want to take what's called a copy of the Virginia plan, the New Jersey plan, and the Connecticut compromise and cram it down their throats because it's how we're the thing's written, and they can whine about it or be right about it in their souls till hell freezes over. But the bottom line is, until they get 38 of these states to throw the electoral college out, it's not going to happen, and that's not going to happen anytime soon. It hadn't happened for over 200 years, and I'm not betting on it to happen. Just like fading the United States of America since 1792 has been a bad play. All right, so that's the election map, and you can kind of look at that and tell that Trump's going to have some trouble with Silicon Valley. Trump's going to have some trouble with Wall Street, and Trump needs to reward the big lakes. And he's going to get shoved back on all that, but that's not his biggest problem. The biggest problem is that the presidents, when they come into office, get blindsided always. It, I don't think, and I've said this publicly, and I'll say it here. I think Trump has about the worst cards of any president coming into office of anybody I've seen going back to Reagan. Reagan had to make a quick choice, and it was to go with Volcker and squeeze inflation out of the market created by the Great Society and the Vietnam War from 66 to 82, and that was one of those times when you could fade America, just like you could fade America from 1828 to 1858. Some people mark that 1858 low at 1870. I tend to look at it more as the year 1858. And so anyway, that's where he's going to be, and that's what he's got to do. And his real trouble is going to come from the fact that the cards that he's been dealt is exactly what the perma bears rest their whole case on, and that's debt. And I think to look parochially at America and think that that's where the problem's going to come from first is not the odds you need to really be looking at. You need to be looking at the Italian banks, the LIBOR spread, and then ultimately you need to be looking at France, which comes down in May. So the idea seasonally of a larger sort of correction that should start, somewhere in the early, winter starts December 22nd on my 62nd birthday. Sometime in the winter, you should get some sort of a peak and get a really decent correction off of it. But as long as 2083.79 holds and 2020, your last chance on saving this thing would be 2029.50 plus 3.14 cash, which was the fair value on the day of the Trump overnight debacle. And I don't place nearly as much emphasis on that relationship of around, just round it off, 2032.50 cash. That was fair value adjusted cash, had cash been open in the middle of the night. As long as those prices hold, we're in a bull market and nothing else to look at. And that 2187.44 is more, the low on Renza is more along the lines of what's going on this whole structure rising and whether or not we take out 2285.93. All right, I'm getting pretty near the end. And, oh, there's Florida. Now, this is what I really know something about. That is Florida, and that's how Florida works. And if you see that big blue J in there, that's where I'm from. And the biggest, right where that purple line cuts through that blue, is the biggest county in Florida. And that's where I live, and my family suggested the name for it. And then my family founded all the counties except Charlotte going down Collier. So they founded Polk, Hardy, DeSoto, Lee, and Hendry. And so that's why I sound so much like a hick. But this is how the vote works, and this is why when Donald gives his speeches about loving the panhandle, he's really talking about Floribama. And if you were from where I was from, which is Bartow, Florida, the county seat for Polk County, used to be Fort Blount, it was really easy for 100 years. It was like the stars fell on you, because you could, as long as you could get either Miami or Jacksonville in your corner, everybody else was like you. And so the senior senator from Florida and an American Bar Association president and 5 generals and I don't know, a couple secretaries of state like Katherine Harris, infamous for the 2000 election. I went to high school with her and the Secretary of Agriculture, Bobby Crawford, who were 2 of the 3 people that worked for Florida on that race, along with the governor, because we have a cabinet for them. One of them was 5 years ahead of me in high school, and the other one was 3 years behind me in high school. We've all known each other since diapers. So it's really that Florida really, until jet travel and air conditioning and Mickey Mouse came in, was a state in the South, and was the smallest state in the South population wise. Now it's the 4th, soon to be 3rd largest state in the union. And anyway, that's how the vote really breaks down in Florida. As long as you know that, and it's kind of like Columbus, Ohio, where they always test market retail products. It's a real good cross section for understanding how the country's going to play out. And that I didn't really want to talk politics so much today, but I'm telling you, the biggest deal is what's going to hit Trump that he doesn't know is going to hit him. If it's going to hit him, it's probably going to be Europe first. Then second, it's because y'all may not like what I'm about to say, but I'm not going to cut any corners on it. By not paying any attention whatsoever to Simpson Bowles, by the media lambasting John Bonner on the agreement that eventually they got blamed for shutting down the government when it was actually the president that queered the deal. The Federal Reserve has been running this whole show since 1077-44. And I don't see where the links are that I provided to John or how to get to them. But to me, the most important charts are not stock market charts that are in this bag of tricks. And I've just lost my charts. But the most important ones are links to the St. Louis Federal Reserve. And you can get them just by going to Google. And the first thing you want to look at is money supply. And then the second thing you want to look at is a velocity chart. And I've been screaming about the velocity chart since 2007, July the 15th through the 23rd on that top, that, you know, we were getting ready to get hurt real bad and in the markets. And I thought maybe even the real top for the bull market from 2002 to 2007 would happen right there and then. And it has to do with the fact that you got to have, in addition to money supply, you got to have velocity. And we were hitting price inelasticity on housing. And the way that I knew it is I had a good friend who told me in the grocery store in April of that year that he was only getting 35 hours.
Hey, WB, I love you. You know that, but we got to get Chicagostock going, and I got to get on too. We're going to be going into the close here. So if you could do me a favor and wrap it up. Sorry about that. We'll do another webinar another
all right,
day.
I'm going to wrap this up in one sentence. If Trump fails, I am more bearish on this country currently than I've been in my adult life. It's that simple. If he fails, we're screwed. We're headed to 1525 minimum. And that's that. All right. Bye-bye. And I'll be able to track that too.
We don't want to cut WB off, I swear to God. But we do have Chicagostock, and we were going to have Rob, and then I'm going to come in. And we are getting close to a close here. But here's the thing, guys. I'm thinking that we should do another Saturday webinar, like at 11 o'clock Central Time, like we were doing, maybe before the end of the year or right in the beginning of the year. I want to make some good offers, try to get people to join MrTopStep. But anyways, I want to thank WB very much. And again, I really, really, really respect the level of work and effort that you put into what you do, WB. And I saw that somebody said this. I argue with WB about this all the time. But when we set the price for his subscription, we set it at $29. I think the subscription should easily be $100 a month. So any of you guys out there that are looking for levels and flow and stuff like that, get in on WB's product. Now, the other part about this is if you want to join the room, WB's in there live talking about his levels all day long. But anyways, listen, we're going to bring in Chicagostock, and he's always got a good presentation, and I'm going to be very curious as to what he thinks is going to be going on here in 2017. So that said, traders, I'm going to sign off. Chicagostock, you got it.
To me, all right, testing. All right, thanks, Danny. Thanks, everyone. Do audio check. Everyone can hear the audio, and we'll start really quick. Okay, great. You should be able to also see a screen share. The screen share should be a daily ES chart. Okay, and everyone, welcome. This is Stewart Solaka. I'm with Chicagostock Trading. And today, what I'm just going to go over with, I know we're kind of projecting and looking for 2017. So I'm going to share with you some of the stuff that I follow and I've seen and what I use to kind of find projections and get an idea of where the market can get to. So the first thing is, the most important, is that the year is divided into two halves. The first half of the year, which goes from January up until June, and the second half of the year, which begins in July and ends in December. Always, when we begin a new half, always the first 2 weeks is the opening range for that period. So just like when the market opens on today, the first 5 or 10 minutes is that opening range. And it's the same thing with on a macro basis. When we're looking at the first 6 months from January till June, the first 2 weeks is the opening range. So I don't usually like to make predictions or look at, try to call a top or a bottom within that 2 weeks. Want to see what happens within that 2 weeks. Let that 2 weeks play out, because that 2 weeks gives us an opening range which provides 6-month pivots and volatility windows. I'm going to show you really quickly about the volatility windows, but these volatility windows is what creates the traps on a larger scale and what creates the biases to try to expand, whether it's a bullish bias or a bearish bias. And sometimes sometimes you need to create a bearish bias to trap shorts and to fuel a move higher, and then vice versa. If you want to create a bull trap to trap buyers higher, and then that fuels the move to the downside. And we saw that last year at the end of the in the second half of the year. So what we'll look at really quick is on this screen, you can see a daily S&P chart. Now the first half of the year, 2 volatility windows. We came off on the back of that rate hike in December. Now that rate hike, a lot of people were not looking for a hike, but one of the reasons why it was likely that they were going to rake, and I talked about this back in December, that we were looking for a rate hike, is that it was exactly 3 years from when the Fed initiated the 6.5% unemployment target, which was in December of 2012. And if you remember, that's when things really started breaking out, because we were kind of bumping against this 1400 level, and once the Fed said, okay, you got to have 6.5% unemployment before we start raising rates, we had the gap higher in January, and ever since then it's been off to the races. So exactly 3 years from that was December of last year, and that's when they hiked by a quarter basis point. And we saw a lot of people last year were looking for the Christmas rally, and that ended up being kind of a trap where Yellen caught a lot of people off guard looking for that rally, and what it turned out to be was as we see here, is we had the FOMC and the rate hike. The market fell down into 2000, and the rally ended up coming into the last part of the year, the last week. We saw the last week go from 1980 up to 2060, basically retesting that FOMC. And what that was, the way I looked at it, it was a gift to the shorts that, or to the longs that were stuck from that FOMC, to give them a chance to get out. And you know how you talked about fear turns to greed at break even. So if you're long at 2060, goes down to 2000, you know, you're down 60 points, the market is going against you. If it goes back to 2060, you'll be like, okay, it's back to even, I'm going to hold on to this. You know, it's that psychology that goes with it, is that we say, okay, just let it come back to my price, I get out. It goes back to that price, it gives them a chance to get out. And that was the double top that we saw into the end of last year. And to begin this year, we had a gap open lower, which left these longs trapped, and that gave way for the flush at the beginning of the year. So beginning of the year, we had the flush to the downside. The high of the year came in at 2043.50 in Globex. We had to move all the way down into 1804. Now, a couple of things started happening here. Is the Bank of Japan went negative rates. This was the third time we tested 1800. And the first time was in October of 2014. We tested 1800. Who steps up? The Bank of Japan with a stimulus package. That creates a V bottom. We go into new all-time highs. And in October of 2015, or August in 2015, we had another break testing that 1800 level. And the Bank of Japan came in October of that year and reiterated stimulus, and we had another bounce. Now, on the third time around, in January of this year, when prices tested at 1800, this is when Japanese started sweating, and this is why they went negative. And the negative was, the way we look at it, is a sign of desperation. They went with negative rates, and you had Europe also coming in, kind of promising stimulus. So a lot of factors in there trying to defend that 1800 level. And then what happened? That created the bottom. So going back to the 2-week opening range, so you got the big move to the downside in the first couple of weeks of January, and that gave us the volatility windows. It was 1869 by 1976. So in order to establish a bias, the 2-week opening range is 10 days. In order to establish a bias, whether it's a bull or a bear, the market needs to close below the lower volatility window for half of the opening range, which is 5 days, or above the upper volatility window for 5 days to establish a bullish bias. And only one can take place. You can only have a bearish bias or a bullish bias. So if the market closes below the lower volatility window for 5 days, it establishes a bearish bias, and it can no longer have a bullish bias. And what creates is a reversal. So this is what we had in February. Is we had the bottom take place on February 11th, and if you follow on MrTopStep or Twitter, you recall on that day we said watch out for a bounce because FOMC was coming up, and the market was known to rally into that. And we had the V bottom develop. So I'm going to show you a couple of things. Is that V bottoms or upside down Vs get very critical or very important, because a couple of things it shows is goes back to the psychology of the market. You got this is back in January and February, and these are the volatility windows. So right here, 1869, this solid horizontal line is that volatility window. So the market held close below that for 5 business days. You have 2 days in January, and then it bounced into the 6-month pivots. It failed right here at 1920, and then 4 more closes below the lower volatility window. So it established the bearish bias. After the 5th day was February 11th. You got everybody short. And then it turned back up. It created the V bottom. So one thing with the psychology of these V bottoms is, which is what I like to look at, is how they're formed. So if you look at it, for example, if you're long 1920, where this V bottom or where this market began to move down, you got flushed out on the downside. As it goes down, the longs get squeezed out, and who comes in? Shorts come into the market. Sellers come in. As the market turns back up to where it originally fell down from, which was 1920, right? Takes that out. What is it doing in that process? It's squeezing out the shorts. So on the downside, it's squeezing out longs and it's lowering in shorts. On the upside, it's squeezing out the shorts. So everyone's getting the teeth kicked in, right? The longs get squeezed out, the shorts get squeezed out, and it creates a V bottom. Now, when it's a V bottom, The reason why that's powerful is because the buyers who originally got kicked out on the move down from 1920, they have to come back in at the same price at 1920. They're forced to have to pay up at the same price that they were originally long. Now the shorts who sold the move down and they got stopped on the reversal through that prior peak, they get squeezed out and they're forced to reverse and now get long. And by doing that, this is what gives you the projection where if you take the V bottom, which was 1922 by 1802, it's a 120 point range. It gives an objective. You add that to the top of 1922, and that gives you where your upside objective is. And that creates the V bottom expansion because everybody, the shorts have to chase the market above 1920 and the longs have to get back in, and that creates your upside objective. And I'll show you a couple of the V bottoms. But so that was the projection of the highs of the year. So we established the bearish bias, it lured in shorts below 1869, created a V bottom, and we got through 1960, which was the 6-month reversal window. And once we closed above that for 5 business days, it reversed the 6-month bearish bias. It created a reversal bias, which means that gives room to try to expand higher. And that reversal window turned into support right here at 1960.58 was the low on March 10th. And then what happened is we take this V bottom from 1902 to 1800, add that to the top, it got us right into the highs of the year. Now, for me, from my experience, this was my most challenging part of this year was trading after that V bottom. You had the market project a break of the high of the year, 2040. So it took out the highs of the year. Because remember, the first half of the year, many people were bearish, and it took that out, recovered that. So everyone who was bearish the market at the beginning of the year had to reassess. And this is what we had 3 months of the market just trading sideways and chopping around. And then we had the Brexit with the move down to 1980 and then the V bottom right back up, leading us right into the second half of the year, which was July. July begins the second half of the year, and what do we get is we get a breakout through 2100, and it establishes a new volatility window, which was 2170, and we held above that to establish a bullish bias, and the high came in on Jackson Hole, or that's where we topped. Because we began in September, we tested the Jackson Hole high, and we double topped, and then returned down. And then for the month of September, October, you saw we were pretty much waiting on the election. But what was the market doing? It was defending the breakout at 2100 and also the reversal. It was trying to prevent this from happening in the second half of the year. Remember, the first half of the year was a bearish bias followed by a reversal. It sucked in shorts, creates a reversal. The second half of the year, it created a bullish bias, and it was coming down and test this reversal window. So to establish a reversal bias and to trap longs above 2170, what it would have to do is hold below 2100 for 5 business days. We had 1, 2, 3 business day closes below 2100, and then we had the FBI come out with, with the Clinton stuff saying she's okay, and we had the bounce into the election up to 2140, and then the Trump. This is another V bottom because the Trump took out the lows from November and it tested that Brexit breakout, or it got close to testing the Brexit lows, but we had that limit down at 2028 and we pushed right back up to 2150. So recall over here, the 2170 turned into resistance. A couple of times it left the buyers trapped above that. And then once we pushed back up here, we started consolidating. And this in turn created a bull flag. I'm going to show you another V bottom, and these charts pretty much all look the same, but they're not. It's because it's the psychology that comes behind it. So this is the election day V bottom. You had the market start off at 2152. Once Florida started going towards Trump, they got the move down into the limit, and then what happens? It recovers all the way back, and it takes that 2152 out. So the same exact psychology. It flushes the longs on the downside, it gets everybody short, it squeezes the shorts on the upside, takes out by taking out 2152. So anytime you take out where it broke down from, that creates a V bottom. That's your reversal. And what does that mean? It's a cup, and now you're going to get a little bit of a consolidation, and you want to see the market expand up. And the reason is, again, is that all the shorts got kicked out. The longs, everybody pretty much has to get back in above 2152. And the market, if the V bottom is any good, it's not going to give them a chance to defend these lows. It's going to force everybody to pay up above 2150. The longs that got kicked out on the way down and the shorts that got squeezed on the way up, everyone has to come back in, and that gives you your range expansion. So you take the 2152 by 2028 range and add that to the top, and it gives us an objective of 2276. And that was leading right into the December rate hike. So what did we hit right before yesterday's rate hike? 2273 was the high. So we completed this objective, and then and this objective set up the Feds for the rate hike. So now going forward, that's another V bottom. So now going forward, and I'll show you another V bottom, is not only did you have that V bottom in February from 1920 down to 1800, projecting 2040, but now you had a bigger V bottom. You had the market start from the rate hike in December at 2070, fall all the way down to 1800, and it comes all the way back to 2070. That's a U-turn, and that's what they call a cup, right? Cup and handle. So these, technical formations, whatever, a lot of them, and you don't want to look at, say, oh, this is a cup and handle. Think about it as the psychology of seeing the reversals and the V bottoms, because that's how they form. Not it's a cup and handle, because you'll see a lot of different patterns that end up failing. What you want to look at is the basic psychology behind it, where the market recovers the level where it failed at, and it creates that U-turn or that V bottom. So now, if we take the V bottom that was started in December, and then we recovered that in April, that's your U-turn. And then what do we have in April, May, and June, and July? And this, in my experience, was one of the hardest parts to trade this year, was because it was sideways chop. Anytime you trade chop, for me at least, I don't know about you guys, but for me, trading choppy markets is the most challenging, because it tries to break out and it fails, it tries to break down and it fails, and what is it doing is just digesting and consolidating prices, and in the meantime, it's messing with everybody. It's pretending like it's going to go up, it's going to go down, but it's consolidating and is building a base. But what you have is everyone who, back to the psychology, is everyone who got trapped or who was caught on the wrong side in January betting that the market was going to go down, they were going to have to reverse and start to get long as the market made new highs for the year. So you take the range from the high of the year, 2040, down to 1800, that's a 240 point range, and you add that to the top of the high of the year at 2040, and where does it give you? Up to 2284. And that was when we were right in April. So we're getting close to that, but it doesn't mean the upside is going to be over with. It just means, because we're in uncharted territory, so we need something that gives us an idea of where the market can go to, just like WB was looking at. And his wave 5, I think, is very important, because that's what, you get. Your wave 5 is always the strongest wave of that Fib, that 1, 2, 3, 4, 5. The fifth wave is always the strongest, and that's the one that ends a move. In this case, it's a bull move, so that's the one that ends the move. So now we're coming into this 2284, and you can see we had the cup and then 3 months of sideways. It's building a base, it's consolidating and going sideways flat. So that gives the objective of the 2284s, and we're close to that. And I'll show you another V bottom or another cup and handle, is the Dow Jones in the year 2016. You had the market start 17,760, falls down to 15,000, recovers 17,000. What do you have is a 2,400 point range. You have your cup, or you have your V bottom, and then the consolidation or the chop, right? And then expanding above 17,760, where does it give you an objective of? If you take that 2,400 point range, add that to the top, gives you a target of 20,155. And we're pretty much only a couple of hundred points away from that now. If we look at the weekly here, you see the reversal, and then even on the Trump, it held that retest of the highs of the year. And then this is what I see this is the capitulation, or this is the parabolic move to the upside, squeezing out the short side. But what is it doing? It's completing its target of 20,000 into the end of the year. December ends the second half of the year, and that's what completes the second half of the year. And it's doing so, it's squeezing out all the shorts, and it squeezed out all the shorts ahead of the FOMC that we had yesterday. So squeeze them out, and this is, you get your objective of 20,000. Another thing is look at the V bottom or the bull flag from Trump, 2180 by 2030, and that gives a target of 2330. Now, cancel that, and let's look at what we're looking at now, or kind of what to expect going forward. Is so we're getting our breakout to the upside. We can see here the bull flag. We broke out. We expanded into new all-time highs. And then we got our pullback down last week on Monday. We bounced right off of 2180, which was the top of that bull flag. Ever since then, we've gone parabolic from 2180 all the way up to 2270, right into the hands of Janet Yellen to hike the rates. So now it's kind of a pause. What's going to happen next? We're consolidating. Everybody's looking at Dow breaking 20,000. So wouldn't look at trying to call any tops, but if we take the February low up to the June high, down to that June low, it gives us the Fibonacci extensions. Again, market is in uncharted territory, so we need an idea of where it can go to, right? Now, 2170 was the 61.8% fib, and we saw that hold up in August. The next level was 2223, 76.4% fib. Kind of front ran that into the end of November with a 2213 high, and we had to move down into 2180. Now, if you remember last week, once we broke through 2225 or 2223 here, there was a big level of buy stops that got triggered. And those buy stops, a lot of them were shorts, but it looks like a lot of them were also buyers coming in on the breakout through 2225. If you notice, if you go back even, I think Danny was talking about how they jammed all those futures in like 15 seconds. There's a huge amount of futures that got jammed on that move through 2225, and that was a big amount of buy stop that got triggered. So that's a breakout buy, and we can see ever since we took that 2223 out, we haven't been back to test that. So where's the next level? We got up to 2276, which was my target going into the Fed meeting. Now, if we continue pushing higher, where's the next level going to be? It's going to be 2298, which is going to be the 100% fib extension, and that also matches up with the 2300 round number, psychological round number level. So in the S&P, it's always look at it in quarters, 25s, 50s, 75s, and zeros. We got through 25s. The next level is we got through 50s. We're trying to hold 50s as support now, or consolidating it. But the next level is 75, which we got close to a few days ago, and we came down. So there's still a lot of stops above 75 that have not been taken out. We kind of fell short of that at 73. If I were looking to fade it, I would have much rather seen the 75 been taken out, then come back below. But for now, it's still a high for now that hasn't been taken out, and the next level above that would be 2300. So before anything, we're getting into the ninth inning of this multi-year bull market, and whatever happens with Trump, we have to look at, for example, in the last administration when the market corrected, they blamed everything on the previous administration, which was Bush, not under the current one. And in this situation, if we do see a market correction, it's going to be blamed on Trump, just like Trump was talking about how the Fed is keeping interest rates low. Well, they're going to have to, because he's looking at spending a lot of money on infrastructure and stuff, and if they start raising rates, it's not going to be good for the debt and for borrowing money. So he's going to need them to keep the interest rates low. Also, to borrow money or to do quantitative easing. If they raise rates, it's not going to be good for his administration because it's going to make borrowing harder and it's going to make paying the debt harder. So in my opinion, I think we're going to see a correction in his administration because then they can pin the blame on a Republican president that came in and once again messed up the market, not the fact that what the Fed is doing and kind of creating all this juice into the environment, into the market. So what we want to look at is for next year, is the first 2 weeks of January. That's going to be your opening range, and that's going to give, the first 2 weeks are going to be volatile. That gives us the opening range and also the volatility windows for the first 6 months of the year. We're going to look at those volatility windows and the top and bottom of the range, and if we see an expansion through the top to establish a bullish bias again, like we had the second half of the year, then that will be the expansion, the final expansion to the upside, and we'll look at if there is any trap that becomes set. Now, anytime we're trying to look at a top or a bottom to be placed, just like I think WB mentioned also, I want to say it's a formation. You know, I I don't have the word in my mouth now, but it takes time to develop. It doesn't just happen in one time. It takes time to create a top. Sometimes your bottoms happen, like you bounce like a V bottom, but tops form. So don't think of it, I want to try to sell this, get in front of it, and look for a top. Because even if the market corrects and falls down, it doesn't mean you missed the top. It means that it just rejected a price, and now you want to wait for a retest. And I'll show you a couple, quickly right here. This is, for example, the Nasdaq when it topped out last year. Is you have your top formation into the second half of the year in December, or it creates a topping effect. So you have the high in December. Now, if you didn't sell that high and the market fell down, you're thinking that you missed the top. Now, this is where it comes in, is that don't try to pick the tops. Wait for them to form. Wait for the market to make a new high, fail in expanding because it shows a failed auction and a rejection. And on that rejection, then you have a high to defend, and you look at selling the retest. So always wait for a high to fail its auction and a rejection, and based off of that rejection, then you can come in and defend that. And you can see this created a right shoulder, and you always want to look at selling that right shoulder because that gives you close to the exit. You stop out on the high. But we're looking at retests and where people become trapped, and you take that range, and that gives you your objective to the downside. So that's how how they form. And the same thing, if we look at you can go have the ultimate short squeeze, 65 to 1441. That was the ultimate short squeeze, in my opinion. Everything above 1441 has been kind of the bubble that the Fed created from December of 2012 when they sent 6.5% unemployment. And then remember, it went from 1400 to where we are now, 2200. So again, the tops formed. The flash crash, you had a head and shoulders. You didn't sell this top, it's okay because you had a retest. And then you had your flash crash take place. The same thing in the debt downgrade in 2011. You had the market rally into 1400, distribute, create a head and shoulders top, and it gives you your objective of 1100, and you got 1100. So what I'm trying to get to is that tops, if you're looking for a top, they form. Don't try to pick the top. Wait for it to develop. I know we'd like to see that take place, and we'd like to see some volatility increase into this market. But you want to wait for that to develop. I think like if you look at a couple other things like the bond market, that one's kind of been topped out. This one also, you take the fib extension from when they said 6.5% no rate change in December or in 2014 when we had this low, up to the high in April, down to the low in July, and this is what we just took out, 147.10, 147.11. What was the low last week? 147.10. So I took that out by a tick. Well, we have this Fibonacci extensions, and it gives us this. As we see, what happened to the bonds is it maxed out right against 77.6% fib, right there, 177, right against the 176.4% fib. So the volatility window for the bond market came in at 168 about to 177. Once we broke the lower vol window, we established a bearish bias, had a retest or a bounce back, couldn't recover back through, and then an expansion to the downside. And then again, what's this taken out is the low of 147.11. Right here is where June 2015, 147.11, we at 147.10. Now we hit a low today, I believe today at 147.04. So this is getting close at least to some short covering down into 145. I want to look at 145 for a little bit of a bounce. But overall, I still see the bonds coming down to 132. And I had that projection when the market was at 170s. When we were up here, and a lot of people were thinking, that's going to take a big move. But the reasoning is, again, if you look at this multi-year chart from 2009, you have this channel, and the bonds try to top out last year here, and then we had the correction down, and that turned out to be the low that led us into these highs. So for the last, this year is when we've been topping out. This is the where we went a little bit too far above this channel. You see, we got through this channel. This is why channels work, but don't bet on them where, okay, we'll be closing out here. Where you get your move up, it capitulates all the shorts and it falls right back below this channel. And what happens? All the buyers above this become trapped, and that gives room to the downside. So where we're looking at is falling down to test the bottom of this range. 145 is going to be first support. I'm going to be looking for a bounce. And then if we can expand to the below this channel, just like we broke the top of this channel, I'll be looking at 132 because that gives me a retest of this 2014 low, which is 128. Okay, and I'm going to leave it there really quick. The cash chart of the S&P right here. We had the bear trap on the election, and then Thanksgiving. This is the breakout right here where we had the gap open and we've broken out to the upside. So this week, last Thursday was the contract rollover where we had the 3150 low. We pushed up, we hit 73, and then yesterday double topping at 72, came down to fill the gap from Monday, and we caught a bounce off of that. Today testing that high, you can see here, yesterday taking out Monday's low and then failing to break. And then in the overnight, chopping sideways below the 3-day pivots. And then we got the squeeze back to retest yesterday's bull trap above 22.65. So short term, we have buyers that are caught above 22.65, which is creating this resistance. And this can give way for at least a little bit of consolidation and chop. And it does create, this is the head and shoulders pattern. So the sellers defended at 22.65. In order to confirm a head and shoulders pattern, what does they have to do is they have to take out this neckline at 22.43. Again, buyers need to recover back through 22.65 to recover the longs that got stuck buying into the FOMC above 22.65 on Tuesday and yesterday. Okay, so that's the short term. And besides that, again, I'll leave it at, look at the first 2 weeks of the opening range in January. That's going to be the most important part that's going to set the tone for the first half of the year, just like we did this January and this July. And, at least that's what helps, gives a little bit of a guide to try to get projections of what's going to take place. And also it clears the opening range, where let the dust settle and give us the windows and kind of play off those. So I wish I could take some questions, but I see we're kind of running out of time here. So if you have any questions, feel free to
Shy,
shoot me out.
I love you too,
Yeah.
but I got to get my presentation done. We're getting late in the day here. We'll come back and do another webinar in a couple of weeks.
Okay, have a good one.
All right. What's up, everybody? So I want to thank Shy Stock. He is so studying on what he does, the systems trading and all the stuff he does. He really knows his stuff. And I don't mean to cut him off. I want him to do as much as he wants. But like I said, maybe we need to come back on a Saturday, do a couple-hour event where everybody gets a half hour, 45 minutes or something like that. That way everybody can get everything out of it that they need to get out. The presenters can get out what they want. But anyways, again, I want to thank everybody that attended. I want to thank all the people that presented. And you know what? That's what trading's about. It's about sharing, trying to figure out what works, what doesn't work, and trying to fit that into your toolbox. And I saw what, here, let me go back and let me look at it. I saw that stuff that you guys posted here. Let me see. About what Zafari Z said about having a plan and executing it. I agree with that. And I'm going to talk a little bit about that. And I also agree with, putting the work in. And again, not all the time do these plans work out, even if they are the best made plan. With the markets the way they are, up and down like this, who knows? Sometimes they do, sometimes they don't. But anyways, I want to explain what this picture is. You're probably looking at it. You're probably saying, what the hell is that picture? That picture is of a clerk on the trading floor. His name's Skipper. And Skipper was in the 1987 crash, and that is a picture of Skipper in the 87 crash. And I know that people don't necessarily want to make correlations, or they don't want to think about stuff that happened in 87 to currently what's happening. But I think that there is a lot of underlying possibilities that things could repeat themselves. And I'm not saying that they will, but I remember very clearly in 1987 how that worked. You know, I've talked about it on Twitter. I've talked about it on Periscope. But at the end of the day, the S&P got down. Let me flip this. Let me flip a couple slides. And I'm not going to take a lot of time, you guys. You know, we got down to what, 2028 half the night of Donald Trump. Is that right? And then we've rallied all the way up to 2273. And I think this is an amazing move. And I know that people will say, well, we've had other moves like this. I cannot recollect any move like this ever, other than the weeks or the months or weeks leading up to the 87 crash or the tech bubble in 1999, 2000.
Hosedt hummus is a symphony of
I'm all
accept.
for Donald Trump and what he's doing. I think that the
Our mission
status
is-
quo needs to
Oh
be shaken.
yeah, these chicken
I
and
think
enchiladas.
by shaking up the status
I
quo,
call
what he's
shotgun.
doing, even before he's gotten into the White House, is he's projected himself as being someone that's looking for change. And that in itself is good for the market. But I'm not really quite sure about how this is going to play out. You know, stocks tend to hold their gains into the end of the year, but we've seen a lot of times where the S&P starts to sell off immediately in January. And we did that last year, did we not? Well, with these types of gains and kind of an uncertainty of what's going to happen in 2017 with all this stuff going back and forth and all these policy changes that he wants to make, I do agree. I think it's going to be a great year for trading. And to tell you the truth, I can't wait for 2016 to be over. I want to start afresh. I want to start anew. And I want to get back to trying to call in my own volume levels and buying the falling knives, selling the rips and buying the dips and all that stuff. But I will agree about one thing, that you do have to have a plan. And if you don't have a plan and you go into something half-assed, you usually will get beat. Now, I want to explain something. I'm very, very honest about my trading. And I was doing okay at the beginning of the year. Then I started to slip going into the spring. And then it's just been a gradual kind of slip. Not gigantic money. But what I've done over the last couple of months was very uncharacteristic of me. I think Fair Value Trader would tell you the same thing. When volatility started to pick up, you know, you had the stuff that went on with Brexit. And I think that the two main events are Brexit and Trump. I really do. Everything else seems to be small in comparison. Is Brexit over? No. Is Donald Trump's situation over? No. It's just beginning. But that said, there's a lot of times when you start into a new year, it's kind of like the markets will reset themselves. And I think that that's what we're going to see. Now, does that happen right away? I don't know. But I got this feeling that what we're seeing now will be different, at least in the beginning of the year. And at some point during the year, I'm not sure if it's going to be mid-year or the summer, how long it can go out. But I'm going to stick to my guns on this. I'm predicting that there's going to be a fairly large sell-off in the S&P. Now, I saw London Crusader ask, could the S&P get back down to 1,500? I'll just say one thing. That Mark Fisher, a very, very smart guy, Mark Fisher went out on a limb a couple of years ago when he said that crude oil would never trade under $90. So I think to say that it's impossible that the S&P trades back down to 1,500 is not. It's a real possibility. There could be a climate in which the markets really get into a corrective phase, and we see big sell-offs like that. But that said, I don't think that that's just going to come right out of the chute. And again, you know, you guys, I'm going to be honest. I put some slides together, but I'm not technical like WB. I'm not as studied as, say, Jeff Hirsch. Jeff knows his stuff. He's been around it his whole life. He knows it the back of his hand. And when it comes to Shy Stock, he's developed his own trading system. He knows every nook and cranny that goes with that system. But that said, I remember how this all happened in 2008 and going into the recession. And according to FactSet, and this is really important stuff that people aren't really paying attention to, that 2016 was the fifth straight month in which quarter, in which S&P earnings fell. Now, if you look at this, I think that there's a possibility, as rosy and as great as things are right now, that it can't just go on like this without some type of reset. And also, I don't want to talk politics, but at the end of the day, I am rather concerned. Trump is a very public person. And right now, he's set to be the next president of the United States. And who's to say that there couldn't be some type of assassination attempt? You know, he's made a lot of enemies around the world, and he hasn't even made office yet. And that's something that the pit bull is very, very concerned about. He trades his option positions, but he never wants the markets to go sharply one way or sharply the other. And that's the way the premium traders like it. They like it just back and forth, never breaking out, never breaking down. But I think that 2017 is going to see a lot of big moves, and not necessarily up. Now, let me move this forward. You know, these are is Trader Dave sent me a couple charts. I asked him to run an analog chart for what happened in 1987 and what's going on in 2016. Now, like I said, I remember those days leading up to the crash very well. As I've explained, we did all that big BCCI Capcom business for the Saudi family, and I was instrumental in the 87 crash. When I had to sell that big 3,000 lot out, when they had to put those things back on, out in the middle of the decline in the morning, I know that for a fact, those sell programs I was doing for UBS, the selling I was doing for the Royal Saudi family and hitting all the bids that Morgan Stanley had in Program ARB completely destroyed the market in the middle of the morning. I don't care what anybody said. I had the biggest order in the pit. There was more program activity around our corner in the S&P than any other area in the pit. Now, the reason I'm talking about program trading is because I think that, one, I think it's gotten out of hand. I think algorithmic and HFT trading now are consuming most of the smaller retail traders. And a lot of this has to do with, again, not having a plan. But the other part about it is what I was trying to explain in the opening print that I was writing a little while ago. A normal piece of news that would come out during the day, let's just say, we use that term normal. There isn't really anything normal about this anymore. But I'll just say a normal piece of headline news would come out. S&P would move 6, 5, 4, whatever amount of handles. But now, when you get a big headline, the S&P goes up 10, up 15, up. It's just, things are just not the way things are set up now. They don't even resemble what they used to look like anymore. And I have a feeling that as volatility picks up in 2017, that there is going to be the algorithms are going to play out havoc in the markets. We recovered from our loss that occurred on the flash crash, but I've been adamant about one thing, that the flash crash was not a one-time thing, that there's going to be more of this kind of stuff. And it may present itself in 2017 with the S&P being up so much and Donald Trump taking over office. I think volatility is going to explode. But these are just a couple of examples. Now, have we sold off like that? No. But we haven't completed this chart yet. And I think in 2017, I'll come back and I will complete this chart. Again, another chart kind of talking about the 2009 bull market versus 82. And, here's the thing. I don't know that these charts are exact comparisons of what we're looking at today, but I do know that history has a tendency or does repeat itself. And that's one of the things why I think Jeff Hirsch and Stock Traders Almanac is so important. You have to have some kind of focal point that you can go back to and look and see how these days went, or how they went, and then how they went after. And I think 2017 is just going to be a very, very volatile year. There's nothing really big into these charts, you guys. I mean, I was trying to come up with something that would be outside of what the normal everybody's talking about, but there's not that much. There's not really, if you go into the internet and you search 1987 crash compare to Donald Trump rally? There's a lot about stuff out there. We searched it up and down. And while there is stories out there that make some comparisons, most of those comparisons were made in like October, August, September, October. Not a lot of that stuff going around right now because everybody's so bullish. And I think that that's a problem too. When you've rallied so much, everybody gets so bullish into a rally, there is going to be some type of correction. But anyways, let's nail this thing out. Okay, so we're going to do our end of the year contest. And there's a link here. We'll have one of the guys put it into the Novia so you can click on it. But I really am interested in where you guys think the S&P is going to go out at year end. And I'm willing to pay you $500 to see your bet. And the thing is that as we go into 2017, I really do believe it's going to be a different animal. As you pull away from zero borrowing costs and all this quantitative easing and what's going on in Europe, and obviously Greece is going to be a problem. Nobody's really talking about that much, but that's going to come to the surface again. I got a couple notes I took. Hold on. Well, like I said, I've seen this before, where the S&P closes out the year very firm, and then in January takes a duck. 2017 is going to be the year of the trader. I'm 100% sure of that. And then let's see the other side. Okay, so here we are. We've got the Fed rate hike out of the way. Tomorrow we'll have the December options expiration out of the way. It's going to go without any hitches, and then I think we're going to go into a very slow period, a quiet period. I talked to the Pitbull about this. I can't speak for everybody, but I can see that right now we've got 1.5 million minis traded. But I think as we move forward into next week and we start getting closer to Christmas, these volumes are going to drop back significantly. Now, if you're looking at the end of the year trade, I think Jeff will tell you the same thing. The Santa Claus rally doesn't come until after Christmas. And I think the next week we could get a little bit of back and forth price action, maybe a little bit more down. And again, I think if we get under 2240, you can get a little bit more back down to 2220, something like that. But at the end of the day, I think what's happened here is all this asset allocation out of bonds. When look at I had the bond chart up, and look at how the bonds have come down. And we got down to 147.01 or 147.10. That was where our lows came in. Yeah, 147.10. And then we recently popped it back up to 150.05, and now we're back down to 148.02. As long as these bonds are being liquidated, that money is going to be put into the stock market. It's the largest asset allocation ever. Now, before I go, I wanted to say one thing. That in the 1987, in 2006 and 2007, at the onset of the credit crisis, I remember when the Pitbull said to me that there was rotten wood floating around in the stock market. And he said, and I remember him explaining it to me. I asked, what do you mean? He said, well, all these brokerage stocks and all the brokerage stocks and all the bank stocks are getting killed. Now, we are in some type of recovery right now. I'm just not sure how long it's going to last. But at that time, when he said this to me, he also said that there would be an enormous shift of wealth out of the United States. I think what's going on right now is that shift of wealth is starting to move back into the United States. I really have a strong feeling about this, about the institutions being underinvested, the hedge funds being underinvested. A couple of weeks ago, when the S&P started going up, when we had that glitch that day, where the S&P popped from, I can't, was it 35 quarter or whatever the price was, up to 38, and there was like 60, 80,000 minis that traded in that blip. I think what that was is that a lot of these mutual funds / pension funds have no time whatsoever to go in and try to pick individual stocks. You're going into the end of the year. They need to be vested. I think that's what's going on here. I think they're pushing money right into they're just shoving money into the stock market right now. Does it show up on the MIM at the end of the day? No, it's not. But that doesn't mean that there's not big buyers still going on in the S&P. Now, The last thing I want to say is bringing back the money back to the U.S. out of bonds. And then the final thing I want to say is I am all for making America great again. I think our leadership has let us down quite a bit over the last several years, and anything away from the status quo is going to be good. Do I think it's all going to go easy? No, I don't. And again, I'm putting my name out there. I've been saying it for a couple months that 2017 will see one of the largest corrections that we've ever seen. So I'm going to leave it like that. You guys, I want to thank everybody for coming in. And, you know, at the end of the day, we all need to work together. Because if we're not working together and we're not sharing what we're learning, all we're doing is screwing each other. And that's not going to work in the end. I always said that the more of us that work together, the better off we are. So I'm going to leave it like that, fellow traders. I want to thank everybody for coming in. I want to thank Jeff Hirsch. I want to thank WB. I want to thank Stock. All these guys are great. And I want to thank you guys most of all. So have a great day. Have a great weekend coming up, a great holiday. I want to wish you and yours the very best. From Mr. Top Step in the cave in Delray Beach, over and out. Take care, everybody.